Are you ready to make the right investment choices that will shape your financial future? Whether you're just starting out or already deep into your investment journey, understanding where to invest, equity, debt, or preference shares could be the game changer you've been looking for. Stick around, because in this video, we'll break down the pros and cons of each, and help you decide which is the perfect fit for your wealth building strategy. Let's dive in. Equity versus debt versus preference shares. Which investment is right for you? Before we jump into the specifics of equity, debt, and preference shares, let's talk about why investing is crucial. Most of us are looking for financial security, but savings alone won't get us there. Investing is what accelerates wealth. But how do you know which investment option is right for you? Let's start with the basics. Equity means buying a share of ownership in a company. Debt is lending money to the company, and preference shares sit somewhere in between. Each of these has unique benefits and risks, and understanding them is key to growing your wealth efficiently. Let's talk about equity. When you buy equity shares, you own a part of the company. This ownership means you get a share of its profits, and more importantly, you have a say in its decisions. Sounds exciting, right? But here's the catch. With great power comes great risk. Equity investments are volatile. Prices go up and down, and sometimes, they crash. Imagine putting all your money into a stock, and the next day it drops by 20%. Scary, isn't it? That's the risk with equities. But the reward? Historically, equities have delivered the highest returns compared to other investments over the long run. Equity is perfect for investors who are willing to take risks for potentially higher rewards. If you're young, have time on your side, and don't mind short-term market fluctuations, equity could be a strong component of your portfolio. Quick question: what's the first stock you'd invest in if money wasn't a problem? Let me know in the comments. Next up, debt investments. Debt means you're lending your money to a company or government, and in return, you receive regular interest payments. It's low risk compared to equity but also offers lower returns. Debt investments are ideal if you're looking for stability and predictable income. For example, when you invest in bonds or debentures, you know exactly how much you'll get back. It's like lending your money with a fixed interest rate. Unlike equities, where returns fluctuate, debt is much safer, which is why many conservative investors prefer it. But here's something to think about. While debt is stable, inflation can eat into your returns. If inflation is higher than the interest you earn, your money is actually losing value over time. So, is debt still a good choice if inflation is high? Let's find out in the next segment. Now, let's talk about preference shares, a hybrid between equity and debt. These shares give you the best of both worlds. You earn fixed dividends like debt, but you also have a claim on the company's assets, like equity. Sounds perfect, right? You get steady income and a priority claim over equity shareholders if the company winds up. But here's the trade-off. While preference shares offer stability, they don't give you voting rights in the company's decisions. You're a silent partner, so to speak. If you're someone who wants the best of both worlds, lower risk than equity but potentially higher returns than debt, preference shares can be a smart addition to your portfolio. Now that you understand the basics, let's compare them head to head. Equity: high risk, high reward, suitable for long-term, risk-taking investors, offers voting rights and potential for high growth. Debt: low risk, low reward, ideal for conservative, income-focused investors, provides stable, fixed returns but vulnerable to inflation. Preference shares: moderate risk, moderate reward, great for investors seeking stability with a hint of growth. No voting rights but priority over equity in case of liquidation. So, which one is best for you? It depends on your financial goals, risk tolerance, and how long you're willing to invest. Equity for growth, debt for safety, and preference for balance. The key to building a solid investment portfolio lies in diversification. Don't put all your eggs in one basket. By mixing equity, debt, and preference shares, you can balance risk and reward, making your portfolio more resilient in the face of market changes. Remember, every investment decision you make today has the power to shape your future wealth. So, take the time to evaluate your options, align them with your goals, and invest wisely. And if you're ready to make your money work for you, start today. Hit the subscribe button for more insights into smart investing, and check out our previous video where we dive into the power of compounding. Trust me, you don't want to miss that one.